I believe that we're on the doorsteps of one of the largest buyer surges our country has ever seen and may ever see. If you look at what's going on in the economy, with the Federal Reserve, with mortgage interest rates, and specifically demographics, I think that we can draw a strong parallel to what happened in the early 80s. And that was the baby boomers entering the real estate market and fueling the real estate market for 3 decades. Hey all, I'm Keith Collins, a mortgage lender in Nashville that's passionate about helping people finance real estate smart. In this video, I'm gonna go through a ton of graphs and all the data to support why I believe we are on the doorsteps of one of the largest surges in buyer demand our country has ever seen. Follow me on this. Let's start with the Fed. I think it's really important to point out that Jerome Powell, our Fed president, is not a trained economist. He's actually a lawyer. Now, I'm not sitting here saying some guy in Nashville, myself, knows more about Jerome Powell and the Fed chair about how to guide this economy, but I do think it's worth mentioning that he is not a trained economist. This is a lawyer that is guiding the country moving forward, and they're most likely going to get it wrong. But check this out. Don't beat them up for it. They always get it wrong. And what do I mean by get it wrong? They go too far in slowing the economy down and throw us into a recession. Follow me on this. This is actually a Fred graph. This is from the Federal Reserve, and this is going back to 1955. What it's showing is the last 10 Federal Reserve rate hike cycles. So the Federal Reserve hikes interest rates with the idea that they're gonna slow the economy down. Maybe we should dive into what the actual Federal Reserve is doing. The federal funds rate is the cost in which banks exchange money to each other overnight. It's the cost at which they borrow money for the Fed and then in turn lend that money out to you. So if I'm a bank and I was able to access money at 2%, but now I have to access it at 5%, and then I'm gonna go lend to you money for a credit card, that money I'm gonna lend to you is now more expensive because my cost to acquire is more expensive. So what the Federal Reserve is trying to do is raise the federal funds rate up, slow the economy down, making access to money more expensive. So if I'm gonna go buy a car, but now all of a sudden that auto rate, instead of being 6, is 12, the payment's gonna be a lot higher, and I may be less likely to purchase that vehicle because of the increased monthly expense due to the financing. So the Federal Reserve is raising the federal funds rate, trying to slow the economy down. The last 10 Federal Reserve rate hike cycles, they've actually thrown the economy into a recession. So as you look at this graph, you're gonna see the red rate hikes, and they're gonna actually see the gray columns coming down. That is a recession. And if you'll see here, going back to 1955, rates go up, we hit a recession. In the 60s, rates go up, we hit a recession. In the 70s, rates go up, they put us into a recession. Happens in the 70s again, happens in the 80s, happens in the 90s, happens in 2000, happens in 2010, which is the Great Recession. That one was different. It still happened. We had a Federal Reserve rate hike cycle and we went into a recession, but I would argue to say that the recession of 2008 was a housing-related recession. It wasn't necessarily an economic recession. The U.S. mortgage industry and the U.S. housing market caused that U.S. recession. And then, a lot of people don't realize this, but we actually did have a recession in COVID. We actually had a federal rate hike cycle, and then the country actually went into a quick recession. This is important. I'm going somewhere with this, and I'm trying to build my case for potentially lower interest rates in the future. I'm not making a prediction. What I'm just trying to show you is what happens, and maybe if history repeats itself, we'll see lower interest rates again on the horizon. So this has only happened 5 times in the last 40 years. We're looking at another graph here. And what this is showing the inversion to the federal funds rate and the 10-year treasury. It's only happened 5 times. Every time this happens, again, we've got a gray column coming down here showing a recession. We have an inversion, we have a recession. So in the 90s, inversion, recession. 2000s, inversion, recession. 2010, inversion, recession. We had another inversion in 2020 for COVID, recession. And during this rate cycle, we've actually seen the widest inversion ever in the last 40 years. What happens after inversions? We typically hit a recession. Recessions actually aren't bad for the real estate market. If you look at recessions outside of 2008, we typically actually see home prices stabilize or increase because in a recession, sometimes entering the recession or during or exiting that recession, mortgage interest rates typically drop, which actually makes homes more affordable. Hey y'all, my goal with this channel is to teach you how to finance real estate smart. And if that is something that you're interested in, please make sure that you like this video and subscribe to my channel so that you get to see more content like this. Now, this is the impact on a 30-year fixed mortgage during, entering, or after a recession. If we go back into the 90s, interest rates went from 11% to 7.5%. Going into the early 2000s, 8.5 to 5.5, 2008, 7% to 4.5, and then our COVID recession, which was 3.5 to roughly 2.5. Some people actually got an interest rate in the ones, which is crazy. So if we look at all this through a federal funds rate cycle, we typically hit a recession, When we hit a recession, mortgage interest rates drop, which usually makes homes more affordable. There's a term I like to use right now, and I'm jumping around a little bit on you, but I promise I'm going to bring this back home at the end of this video. But it's house hostage. I believe a significant portion of the population that owns a home and has a mortgage on it are what I call house hostage. What do I mean by that? The home that they're in today, they could not afford if it was at today's interest rates. And if we look at this graph, I think which is really interesting is this graph is actually showing us all mortgages in America by year and what percentage is at what interest rate. Okay, so if we look at this in 2023, 81% of all home loans in America are actually under 5%. 80% of all home loans in America are under 5%. That means only 20% are above the actual interest rate that we could get today. So if they were to refinance, if they were to sell and go buy another property, they're going to be trading up to potentially a larger home, but a larger debt. 61% of mortgages in America are under 4%. And then it goes further to say that currently 23% of mortgages are under 3%. So what's happening is we have a ton of buyers that are being held back right now because they want to buy the home in the new neighborhood with the new school district, with the cul-de-sac and the bonus room and maybe the extra garage space. But they just can't wrap their brain around the idea of trading from their 2.5%, 3.5%, or 4% interest rate into a 6.5% rate. So what's happening is all this inventory that would typically come to market is not. People are not moving. They're not listing their home and moving up. And that is affecting inventory, which helps and hurts demand. Moving on to my next point. Housing is seriously undersupplied. This is a graph showing how undersupplied housing is. Mark Zandi, the chief economist for Moody's, the largest ratings agency in the world, and he's probably one of the highest regarded economists in the country, actually just gave a really interesting presentation to the Federal Deposit Insurance Corporation, the FDIC, on why he thinks that housing is undersupplied. And what he came to is that we are short 1.6 million homes in America. Now that's not just single family homes, that's actual rentals. So they break it out here, 1.6 million homes, 700,000 homes that someone would buy and live in, and then 900,000 homes or apartments that people would actually rent. So the problem is we are short available homes. There are people that want to buy the home, but the home is not available for them to buy. I believe what's happening here is this is actually creating a floor, a concrete floor in housing. This is creating a base that it's going to be very difficult for housing prices to go below because we are undersupplied. We do not have houses come to the market because people are not listing their home because they're house hostage, right? And because of that, we are undersupplied based on demand. Something interesting also I'd like to point out about this is that we look at years, we saw a ramp up in housing in the early 2000s, which led to the peak in 2008, 9, or 10, just depending on kind of where you are in the country. We were oversupplied at that point in time. And what happened when we were oversupplied? Home prices started to come down. So if you look at kind of where we're at right now, is we are significantly undersupplied, which I think is stabilizing home prices in the face of higher interest rates. So people have been asking a lot, like, interest rates are so high, why are home prices not coming down? Home prices are not coming down because there's still enough demand in the market and not enough supply to meet that demand. So people are still buying homes. They're just a lot more uncomfortable with the payment they're paying for the home. But it is also keeping kind of a lid on home prices, right? So interest rates are keeping a lid on home prices, and then the supply is keeping a floor on home prices as well, and we're kind of stuck in this channel. Something has to break. On the same note, on kind of supply and structural undersupply in housing, this is a really interesting bar graph. What this is actually showing us is all one unit detached, one unit detached, 2 to 4 units, 5 to 19 units, 20 more, and even manufactured and mobile homes. So this is basically showing us everything that somebody could potentially live in America and how many we created in that 10-year stretch. But what's really interesting is we kind of know what's coming to the market. When we look at a builder that is doing a significant community that they're going to be building out, it is years before they can actually go to market and go vertical on that home. There's environmental impact studies, right? There's grading, all the infrastructure and support that they have to put in, the permits that they pull. All this information is available to us, the public, to take a look at to see what's coming. We know what's coming in the next 2, 3, 4, 5, or 6 years to the overall economy, but any given a market. And if you look at what's coming in the next 10 years from 2020 to 2029, it is a very low amount of homes. And there's actually an interesting parallel that you can grab back to the 40s. We actually did something similar in the 40s. We brought a significantly low number of homes to the market in that 10-year stretch. Well, what happened in the 40s? World War II. And during that period of time, there's about 150 million people in America. We look at what we're doing right now, we have over 350 people in America, and we're about to bring to market the same potentially less homes that we brought to market in the 40s. I think it's a problem for future housing, meaning we are not bringing enough homes to the market. There's too much demand for this. And again, I think this puts a floor on housing because we're just not going to have enough. Okay, I'm jumping ahead, and now we're going to talk about demographics. So these are two interesting slides here that I've kind of pushed together. We've got one more that really relates to this, but I want to talk about the demand. Who is buying houses today? So the Federal Reserve actually tracks this every single month. They look at the average age of a home buyer every single month, and they report it. You can Google it, find it at Fred. It's all there. The average age of a home buyer today is roughly 35 to 36 years old. And so if you're looking at this graph, we've got homeownership rate by age. You look at if they're under 35, homeownership rate is about 38%. But as soon as they clip over 35 years old and go up, it jumps from 38% to 62%. So the average age of a new buyer entering the market is roughly 36 years old. And then going on from there, it just increases. It's 65% with ages 45 to 54. It's 70% with, it's 75% with ages 55 to 64, and it's almost 80% with ages 65 plus. So as the population continues to age, the percentage of that population that buys a home drastically increases, and that number is 36. The other graph to the left here that I want to show you is population by age. So what this is actually showing us, I'm going to break this down a little bit further, but how many of those people we have in that certain age range. So if you look at the yellow graph here, ages 28 to 30, it's 50 million people. So this is a graph from 2021, but at that time in 2021, the age, we had 50 million people that were ages 28 to 38 years old. You're going to go to this next graph here, and I think this kind of brings it home. So what this actually is, and this is as of 2020, so sometimes these graphs are kind of hard to find, but this is as of 2020. And what this is actually showing us is this is how many Americans were in America at that age. So, 1 to 95. And what I want to point out once again is the yellow numbers in the center. The yellow numbers that are in the center are our millennial population. And the millennial birth rates actually rival the baby boomers. There were more millennial birth rates than what we consider as one of the greatest generations that ever entered the U.S. economy and drove the housing market in the early 80s and 90s and 2000s. And we have an age demographic of millennials that are turning 35, and we have 1, 2, 3, 4, 5, 6, 7, 8, 9 more years of those millennials, those record numbers of individuals turning an age in which they would buy a home. That's not to say that all of them will buy a home. That's not to say that all of them are going to be able to afford a home. But we have record numbers of individuals that are turning an age in America that they would typically buy a home at a time in which we are structurally undersupplied in America, and we have 80% of all home loans under 5%. So we have a huge portion of the population that is not going to sell their home because they're stuck with the interest rate that they have, a housing industry that is not producing the numbers that we need for the market, and we have massive demand coming, and we're potentially in a place where in this Federal Reserve rate hike cycle that the Federal Reserve will overshoot it, will hit a recession, and interest rates will potentially come down. There was a report that came out that said 2/3 of all Americans that want to buy a home in the next year are actually waiting for interest rates to come down to do so. So if 2/3 of Americans that want to buy a home enter the market at the same point in time when interest rates drop, at a housing market that is structurally undersupplied, we don't have enough homes for them, and we have demand, a massive demand coming, I wonder just what that does to home prices. So I hope I've made my case as to why I believe that we are on the doorsteps of one of the largest surges in buyer demand our country's ever seen, and why potentially we'll actually see an increase in affordability in homes with interest rates coming down. If you disagree with me, I would love to engage with you in the comments about all your thoughts.